Hey everybody, welcome to episode 11, Investing Fundamentals. The theme of this episode is investing is ownership. And if you take one thing away, take this: risk and return are linked. In part one of our financial literacy series, we learned how to control money. Now in part two, we're moving to something bigger: how capital grows and how you can use it. Today, we're organizing this into 3 parts. What stocks, bonds, and ETFs actually are, how risk and return are connected, and how asset allocation works.
Because investing isn't guessing, it's understanding what you own. And the best way to see that is to follow Sabrina.
So, last when we left Sabrina, she had done the hard things right. Her emergency fund was stable, her spending was under control, and her income was growing.
But now she's staring at a new number in her savings account and asking the question every new investor eventually asks: where should my money go?
And this is where many people get stuck, because the investing world throws a lot of words at you very quickly. Things like stocks, bonds, ETFs, index funds. These can be really confusing and almost like another language.
So let's walk with Sabrina as she learns what these actually mean.
For a new investor, the stock market starts to look like a high-stakes casino, where one wrong guess means losing everything. Without a way to break through this intimidation, Sabrina remains trapped in the cycle of trading her hours for dollars. Sabrina moves forward by looking past the jargon and focusing on a single core reality. She stops thinking like a laborer and starts thinking like an owner. This shift changes the objective. Investing is no longer about predicting daily price movements or trying to gamble on a hot tip. It is about acquiring ownership in productive businesses.
So the first thing Sabrina hears is simple advice. Hey, just buy some stocks. And she pauses and thinks, what is a stock? When you buy a stock, you are buying a small piece of a real company.
We like to imagine Sabrina realizing this for the first time. She's not buying a lottery ticket, she's becoming a part owner.
Every stock she buys represents a legal percentage of a real company. Behind the blinking ticker symbols are businesses with employees, products, and customers. As a business grows its revenue and profit over several years, the value of that ownership stake grows along with it. Wealth creation becomes predictable when you ignore short-term price anxiety and focus on long-term business performance.
Companies have employees, products, customers, revenue, expenses, and profit. And if that business grows over time, the company becomes more valuable.
Which means her small piece can grow as well. In the short term, prices move on news and emotion, but in the long term, they tend to follow business performance. That's the shift Sabrina is looking to make, from watching prices to understanding ownership.
And then Sabrina also hears about bonds.
A bond offers a direct contrast to a stock. When Sabrina buys a bond, she is lending her money to a government or a corporation in exchange for steady interest payments and the eventual return of her cash. While stocks provide growth, bonds provide the portfolio with stability and a predictable stream of income.
So now Sabrina has a little bit clearer framework. Stocks equal ownership, bonds equal lending, and stocks usually offer higher growth potential. But bonds, they usually offer more stability and predictable income.
And then Sabrina runs into a very practical problem. There are thousands of companies. How is she supposed to pick? That's where ETFs enter the story.
Sabrina faces a practical problem. There are thousands of individual companies to choose from, and picking winners is incredibly difficult. This is where an ETF, or exchange-traded fund, enters the strategy. An ETF acts as a single basket that holds hundreds of different companies at once. This creates instant diversification, spreading risks so thin that one company's failure cannot destroy her wealth.
Stocks equal ownership in a company. Bonds equal lending money for interest, and ETFs equal a basket of investments.
The goal is not gambling.
Right. The goal is building ownership in productive assets over time.
Now here's where Sabrina's education becomes real. Because shortly after she begins investing, the market moves down.
Shortly after Sabrina starts her portfolio, the market experiences a sudden, sharp downward drop. This is the moment to define what risk actually means. In a diversified portfolio, risk is rarely a permanent loss of money. It is volatility, the uncertainty of price swings in the short term. This volatility is driven by the risk premium. It is a mathematical rule. Achieving higher potential growth requires the investor to accept more frequent and more severe ups and downs. Market fluctuations are the mandatory price of admission every owner must pay to achieve long-term growth.
Over long periods, U.S. stocks have historically averaged about 8 to 10% per year, but that average includes significant ups and downs. Volatility is the price paid for higher expected growth.
Many people want stock-like returns with bond-like stability. Like, who doesn't want higher returns, right? But that combination, it rarely exists.
So you have this thing called risk premium then. That extra return investors expect for accepting uncertainty is called the risk premium.
Right.
And this is the lesson Sabrina is slowly internalizing. Growth requires patience.
So, in summary, higher potential return equals more ups and downs. Lower volatility equals slower growth. Risk means uncertainty, not guaranteed loss. And long-term investors are compensated for accepting that volatility.
And at this point, Sabrina asks a smarter question. Not what's the best stock, but how should I divide my money?
Sabrina has to decide how to divide her money between them. This process is called asset allocation. She organizes her investments into a three-part team: offense, defense, and backup. Stocks play offense to drive growth, bonds play defense to provide stability, and cash serves as the backup safety net for immediate needs. Her time horizon dictates how she builds this team. Since Sabrina is in her 20s and won't need this money for decades, she can lean heavily on offense.
She has years to wait out any temporary market drops. This structure replaces emotional panic with a disciplined plan, ensuring she stays invested even when the market is turbulent.
And so your time horizon shapes your allocation. If you're young and investing for decades, you may choose more stocks. If you need money soon, you may choose more bonds or cash.
So markets rise and fall. Without a plan, your emotions can take over, but with structure, discipline can become possible.
And structure protects discipline, and discipline supports long-term success.
So let's catch up with Sabrina again. By the end of this, she has a diversified portfolio. She understands what she owns, she knows why stocks fluctuate, and she's not caught off guard when they do. She allocates these intentionally.
She doesn't expect certainty, she expects volatility and long-term growth, because investing isn't gambling, it's structured ownership.
So today, Lenny, we covered three things: what stocks, bonds, and ETFs are, why risk and return are connected, and how asset allocation creates structure.
And understanding what you own changes how you react.
Investing's ownership, right?
Investing is ownership.